Ever wondered why the market moves against you right before the big move? It's not bad luck, it's smart money. In this video, I'll guide you step by step through how smart money traps retail traders, and how you can trade like them. Let's start by laying the groundwork. What exactly is smart money? It's the big players, banks, hedge funds, and massive financial firms. These guys don't just follow the market, they move it with huge capital and smart plans. While retail traders react, smart money is always a few steps ahead, shaping the game. Think of it like big fish in a market ocean, swimming circles around the small fish. So, what's smart money aiming for? Their goal is simple: get the best prices before major moves. They create fake signals to lure retail traders into traps. Manipulation is real, but it's simply part of how markets operate. If you spot their game, you can trade alongside them instead of against them. Here's a key idea: liquidity. Liquidity lets big players enter and exit trades without getting stuck. Retail traders' stop losses, breakout orders, and trend chasing create this liquidity. Smart money hunts these liquidity pools to fill massive orders smoothly. Without liquidity, even the giants can't move the market effectively. So where do these liquidity pockets actually sit? Mostly just above recent highs and below recent lows. That's because retail traders commonly place their stops there. These spots act like magnets for smart money hunting their prey. It's the reason markets often reverse right after breakouts. And that leads us to one of smart money's favorite tactics, the stop hunt. It's when price spikes beyond key levels to trigger stop losses, then quickly snaps back. Retail traders get shaken out and trapped, while smart money scoops up better entries. The real move only starts once the weak hands are cleared. It's a market shakeout: know it, expect it, and don't fall for it. So, why does this trick work again and again? It's because retail traders tend to place stops just beyond obvious support and resistance. Smart money knows this, and they use it to exploit fear, greed, and urgency. But remember, the stop hunt isn't the move itself, it's just the setup. Understanding this mindset changes the way you see price action. Now, let's take that idea further with something called inducement. This is when smart money tempts traders into bad positions on purpose. Like a small rally before a big drop, or a fake dump before a big move up. These bait moves create liquidity, exactly what smart money needs to strike. They lay the trap, wait, and then go for the real move. And right before a big move happens, manipulation kicks in. This might look like a breakout, a news spike, or a fake rally. But it's designed to shake out the weak hands. Smart money controls the game. The crowd just reacts. If you want to win, start thinking opposite the herd. So how does smart money know exactly where to strike? They focus on clean market structures, clear highs and lows where retail loves to trade. These points become magnets for price, and traps for unsuspecting traders. Recognizing these areas is like reading the market's hidden map. Once you see them clearly, you'll never trade the same way again. Now let's talk about something critical: order blocks. They're the last candles before a major move, marking where institutions entered the market. Acting like magnets, price often returns to these zones to rebalance orders. There are two types: bullish order blocks before upward moves and bearish order blocks before drops. These zones are smart money's footprints, the launchpads for the next big move. But why do these zones work so consistently? Because institutions can't enter massive positions all at once, they need multiple fills. Their first entry leaves a trail, and price often comes back to fill the rest. That return move is your opportunity to enter with them. Order blocks are their footprint. Follow it. Next up is imbalance, also known as fair value gaps. It happens when price moves so fast, it skips over price levels without trading. No buyers or sellers met in that gap, and the market usually comes back to fill it. Think of it as the chart's skipped heartbeat. When price returns to fill that space, it often signals a key decision point. So how do you actually enter trades using these zones? Wait for price to revisit an order blocks or fair value gaps. Then, seek confirmation on a lower timeframe, structure shifts or rejections. Don't just react, confirm intention before committing. Smart entries wait patiently, they don't chase the market. You also need to recognize when the market is about to turn. Look for a shift in structure, a break of a key high or low. Smart money causes these breaks after grabbing liquidity. Catching this helps confirm a reversal. Remember, structure changes before the big move, not after. Let's compare how institutions think versus how retail behaves. Institutions plan ahead, based on logic, structure, and intent. Retail often follows emotions, indicators, or news headlines. Retail sees breakouts as entries, smart money sees traps. Think like the architect building the market, not the tourist watching it. To level up, start thinking like the architect, not the tourist. If there's one trait that defines smart money, it's patience. They don't chase candles, they wait for price to come to them. Retail chases, smart money waits at planned levels. Timing is crucial, but precision is everything. Let the trade come to you, don't force it. Now here's a classic smart money pattern you'll see again and again. First, price sweeps liquidity, usually above a recent high or below a recent low. That move clears out stop losses and traps retail traders. Then price returns to a previous order block. That's where smart money often enters, and where you should look for confirmation. It's a repeatable setup, once you know what to look for. Let's break down liquidity into two types, internal and external. Internal liquidity lives inside a range, between swing highs and lows. External liquidity sits outside those levels, waiting to be grabbed. Smart money targets both, depending on the goal. If you know which liquidity is being hunted, you can predict the next move. It's like reading the market's roadmap. Not all order blocks are equal, some are cleaner and more reliable. Use wicks, imbalance overlaps, and timing to fine-tune your zones. The more precise your zone, the better your entry and the lower your risk. This is where amateurs often fail, they trade from vague areas. Refinement is what separates casual traders from professionals. So what actually moves price? It's not indicators, it's orders. Every candle represents a battle between buyers and sellers. Smart money uses order flow, not lagging tools, to drive price where they want it. They create imbalance, tipping the scale in their favor. Understanding this helps you follow the real story, not the noise. Smart money isn't just about smart entries, it's about survival. Even pros take losses. The difference? They manage risk like professionals. Use tight stops, calculated position sizing, and never overleverage. Your goal isn't to win every trade, it's to stay in the game long enough to win big. Trade calm, calculated, and consistent, just like smart money does. Let's recap what we've covered. We've seen how smart money drives the market through liquidity grabs, manipulation, and precise order blocks that reveal institutional intent. By understanding liquidity, inducement, and structure shifts, you can align your trades with the real market movers instead of reacting to noise. Combining order blocks with fair value gaps and refined entries gives you clarity and precision in every setup. In the end, trading success comes from patience, logic, and thinking like smart money, not chasing price like the crowd. Congrats, you've leveled up. You now understand how smart money thinks, moves, and controls the market through liquidity, manipulation, and precise order flow. You've learned to read price like the institutions do, spotting traps, refining zones, and trading with confidence and clarity. Every chart you see from now on will tell a different story, one you can finally understand. Keep studying, stay patient, and trade with the mindset of smart money, because that's how real growth begins. Next up, we'll uncover how to master risk, psychology, and system building like smart money. We'll break down risk-reward logic, stop losses, and position sizing that keep pros in control. You'll learn how to eliminate FOMO, stay disciplined, and trade with confidence. This is where emotion ends, and mastery begins. See you in the next video.